In this video, I will be going over one of the most important concepts that you can learn when it comes to ICT, in my opinion, and that will be the open, low, high and close, and the open, high, low and close. So as you can see on screen, I've got a couple of candles, so a bullish candle and a bearish candle. And what you'll see on the bullish candle is we get open, right? So what we get is we get a candle open, we then trade down making the wick. What we get then is we get a trade all the way up making the high, so we make this high wick, we trade back down and then we get the close of the candle. And then similarly on the bearish candle, what we get is we get the open, we trade up, make our wick, we trade all the way down, make our wick on the bottom, and then we close the candle. So this is kind of how the candle formation works, and this works the best when looking at the daily chart, in my opinion. So kind of looking at the daily chart, what you would be looking for is you would be looking for the candle to open, you'll be looking for the Judas swing to happen in the terms of this making this low right here. And then if you get involved in a trade right there, you can then look to take part of or the majority of the daily candle, get in and out of the market and secure some profits before we get to these highs, and then eventually close the candle. So I will go ahead and kind of show you a very simple model that you could look at in terms of using these concepts, and it's one way that you can keep it very simple when it comes to ICT, because as you will know, when it comes to ICT, he's got a huge library of content on his channel to go through, and if you're very confused, what you can do is just keep it simple, look at these concepts right here, and if you implement these and keep it simple, like I said, it's very easy then to get involved in the market and know what you're looking for. So what we'll do is we'll come down, right, and I've kind of got this little diagram demonstration here. So if I just pull this over, what we can look at is this right here. So let's just say this is a 15-minute chart. So if we go ahead and get this, let's just say 15 minute chart right here, and what we're looking at is prices coming up. So we're trading up, we're coming towards our higher time frame premium and discount array. So we've got a premium array right here, we trade into this, our point of interest. And then what we get is we get a market structure shift, or a breaking market structure, whatever you want to call it. And then as you can see, we trade through, we create a fair value gap. We've also traded above New York midnight open. So this is very, very important to keep in mind. The New York midnight open, it's something that I look at as a really strong confluence, and it just kind of keeps me knowing where I am within the market. So as you can see, we trade up above buy side liquidity, we get a market structure shift, we trade above New York midnight open, we've got our fair value gap. These are all the things that we're looking for when we're looking to enter in a trade. So we could enter in right there, stop above the highs, and we could sort of trade down. And as I said before, you could look to take a little bit or the majority of the daily candle, depending on how confident you are with your analysis and how confident you are with your daily bias. So if you don't know about daily bias, I will make sure I will put a video up on my channel about that. I've got ways and means that I can look at, finding daily bias, which is quite simple and quite mechanical. So I'll make sure to get that video up and out as soon as possible. But this is kind of the overall idea what we're looking at. So what you can see is sort of the open right here, right? The open of the candle, we trade up, we trade down, we trade back into our fair value gap, we trade all the way down. And then what we would be looking at is sort of towards the end of the day, you would get sort of a retracement, and then we would get our candle close. So this is kind of the, one of the most powerful models, and it's very, very simple. You're not looking at all of the concepts into one. You could, however, add in OTEs into this. You could add breaker blocks. You could add, balanced price ranges, however you want to enter the market, that's up to you. But you could just stick to the 2022 model and trade fair value gaps. So what we'll do now is we'll go into charts and kind of look at some examples of how this would work, sort of just sticking to the 15-minute chart, and you could then drop down onto the 5-minute or the 1-minute, or you could even trade this on the higher time frame if you want to look at this on the weekly candle, the monthly candle, etc. So let's jump onto the charts now and take a look at kind of how this would work. So one thing I do want to explain first of all is accumulation, manipulation and distribution. So what we get is we sort of get Asia session right, and what Asia session usually is a consolidation. So what you might get within Asia session is a sideways movement like this. It doesn't have to always be a sideways movement. It can be, sort of trend line. It can come up a little bit and then down a little bit and then up a little bit. It doesn't have to be always the perfect sideways movement to form our consolidation. But what we get, in essence, is we get a consolidation. We will get a move above this consolidation in the terms of our, manipulation. And then we'll get a distribution to the downside. So how it would look is just something really simple like this. Trade up, trade down, and then we'll get our, candle close. So what we get is our accumulation. We then get our manipulation. And then we will get our distribution. So that's kind of the model we're trading. Super simple. So what we can do now is look at our Asia session. As you can see, the overall bias is to the downside, and as I said before, if you don't know daily bias, I'll get a video out on that. But what we get here is our Asia session, right? And let's just see how we develop through Asia. As I said before, it doesn't have to be the perfect sideways movement. What we would do now is mark out our New York midnight open. So New York midnight open. And then what we would like to see now is price trade above this and then trade to the downside if we are bearish. So let's just kind of see what happens from here, right? So we do start to trade above New York midnight open. We get a trade toward the downside. We get sort of a little bit of a displacement, but what you will notice is we have formed, equal highs right here, and you wouldn't want to get involved in this fair value gap, just for the simple fact is we've not actually taken any liquidity yet. So what we're waiting for is a sweep of liquidity and then a break to the downside with displacement if we're looking to get involved in the market. So price trades back up, it takes out these equal highs. It doesn't take out Asia high, which usually it will do. Most of the time it does take out Asia high, but it doesn't always have to. So, if you want to wait for Asia to be taken out, that's absolutely fine. But if you see these equal highs right here as sufficient liquidity taken out, that's also, absolutely fine. It's not a wrong answer. There's no right or wrong. If you're happy to trade after these are taken out, that is brilliant, and you can then look to get in the market. If you don't and you want to wait for Asia highs, you will need to wait, and potentially you might miss out on this trade. So let's just kind of see what happens. So we start trading to the downside. As you can see, nice displacement down. We've got a market structure shift. We've taken liquidity. So what we could do is we could enter a trade right here. You could sort of, enter sort of on the order block if you want to do that. You might not get tagged in, but it will significantly reduce your stop loss size. But we'll just leave it here for now, and we'll put the stop loss somewhere around here. And then what we can do is we can look to trade towards the previous daily lows, which would be the overall target for this trade right here. The overall target is just under the previous daily lows, which is absolutely fine. If you're entering on a lower time frame, maybe the 5 minute, the 1 minute, you will be in and out of the trade way before this previous daily low right here with a good risk to reward. So please keep that in mind that we are on the 15 minute. So let's see what happens, right? We come up, we get tagged in, and then we do start to retrace, and with us being on the 15 minute, the retracements will be sort of a bit bigger than they would be on the 1 minute, for example, because obviously if you got into a trade up here on the 1 minute, you would be in and out within this, displacement leg right here, which is, pretty good if you look at it like that. But let's carry on and see what happens. Coming into New York session now, and the volume may start kicking in, and then as you can see, we come down, hit take profit, and what you will notice is we have got the power of three set up. We've got our open, high, low and close. So we come in, we trade up above New York midnight open, we trade down, and then we'll sort of get a close somewhere around here. So what we can do is go to the next day and kind of see what happens. So we traded down pretty well right here, and we'll wait to see what happens during Asia. As you can see, Asia is pretty much just going sideways. A sideways movement in Asia, and we will then mark out our New York midnight open. If our bias is still bearish, we could then look to trade if we do get a take of liquidity and displacement to the downside. So as you can see, we come up and we take out Asia highs, so that's our liquidity taken. We then start then moving to the downside. We do get a take of this low right here. This might not be sufficient for you. You might want to wait for this low, but for me personally, I would prefer to be in a trade before it's taken Asia lows. And then what we could do, sort of enter in somewhere around here. So if we enter a trade on here, stop above the highs, and then you could look to take profit pretty much wherever you like. somewhere towards these, previous daily lows, or around 1 to 2, 1 to 3, whichever you prefer. And again, please keep in mind, we're on the 15-minute chart in this example. So let's see what happens. As you can see, the take profit is just around the previous daily low, and we are clearly very, very bearish. We're in a consolidation there. This might be a high risk trade, but for me personally, this trade right here, the most likely thing to happen is for this previous daily low to be taken out. So let's see what's going on. We get tagged into the trade, and then the trade comes down and hits take profit. Again, what we get is we get a trade above the New York Midnight Open. We then break structure to the downside. We return to our fair value gap entry. You could have entered on this order block. So you could have entered on this order block right here. You would have been tagged in and you would have had a better risk to reward. You could have took an entry on sort of this balanced price range right here. And then what happens is we trade down, we come out, it take profit. And because we've taken liquidity, you could expect sort of a retracement, but we're in and out of this trade before anything like that has happened anyway. So that's the overall idea of the power of 3 and the open, low, high, close, and the open, high, low, and close. Very simple stuff to learn, and it's one of the concepts that I think is very, very important when it comes to ICT concepts, and it's one of those concepts that I think you do need in your arsenal if you are going to trade ICT, and it's actually one of the concepts that people do overlook when it comes to ICT. So yeah, if you're looking to trade sort of ICT, I would recommend learning this concept right here. Go on, practice it on your charts. Obviously, it's not going to be picture perfect every single day. There's going to be times where you miss trades, or sometimes where it doesn't trade above Asia highs, or sometimes it might not even trade over New York Midnight Open, but the overall idea is there. And if you go on, backtest it and look at it like that, it does work, and it's a really good concept to have. So yeah, that's pretty much it for today's video, guys. If you did enjoy, please leave a like on today's video. If you have any questions, feel free to drop them in the comments. I'll look to get back to every single one of your comments. And without further ado, thank you very much for watching, and I will see you in the next one.